name is Hardik Desai. I'm a managing partner at JumpStart Ventures. Welcome to this panel, negotiating term sheets, focusing on what really matters. I've been at JumpStart for about 12 years now. I've been in the startup world for about 15 years. And yet, this is one of those fascinating topics where even though we all agree on what things should look like, we have lots of debates and discussions on how to negotiate term sheets. So that's why we are here. We'll go through a handful of topics where our esteemed panelists will present their perspectives representing founders and investors. But before we go there, maybe a quick introduction for our panelists.
Good morning, Howard Bobrow. I'm the chair of the venture and emerging company practice with the law firm Taft. And it's great to be here. And for all I know, there could be 10 people out there or 1,000 people out there. I cannot see anything because of the blinding lights. So I apologize if somebody raises their hand and we don't see it later.
Hello, my name is Jonathon Vinocur. I'm an attorney at Thompson Hine. Spend all my time working with early growth stage technology companies. Thanks.
So let's dive right in. The first question, this should be a relatively straightforward, easy question. Everyone knows what's pre-money and what's post-money, right? Everyone knows what's option pool and what's convertible debts. So, Howard, simple math?
Well, simple math, but to the point you just made, the reason why it's always interesting to talk about term sheets is because what's important in a term sheet, which is really the focus of what we're all going to try to address here today, changes from time to time. One of the things that tends to be consistently important in a term sheet is the pre-money versus post-money valuation conversation. The slide says everyone understands pre and post money. I'm not sure that's true, so I want to give a quick example of what it means. But for those of you that watch the show Shark Tank, the discussion they have when they like a deal, when all the sharks are saying, I'll give you $200,000 for 15% of your company, and then the next shark will say, I'll give you $250,000 for 12% of your company. That's a pre-money value versus post-money value conversation. They don't use those words all the time, but that's exactly what that is. The easiest way to look at it, just from a valuation perspective and ownership perspective, is if you have a pre-money value of, and we're going to use easy numbers for the math. Most people go to law school because they're not good at math, and I'm consistent with that approach. But if you use easy math, you would say if you have a pre-money value of $9 million and you go out and raise $1 million, your post-money value is $10 million. The investor that invested $1 million technically owns 10%, but we're gonna talk about that in a second.
So, Jonathon, what's wrong with that math?
No, the math is great, and the math is helpful and easy, hopefully. The difficulty comes in, and sometimes the friction comes in when we start talking about these other things that are up on this slide, right? In connection with an investment round, frequently you want to add an option pool. You need some amount of equity to help incentivize your team. And at the same time, you're also thinking, well, wait a second, I had those prior investors who invested using a convertible note or a SAFE, right? Y Combinator has that great SAFE, simple agreement for equity. And so where do those come in? And Howard's math is spot on. You know, if that investor's going to put in $1 million and it's a $9 million pre-money valuation and they own 10% after it's over, well, that 10% doesn't include that option pool. So the 90% portion, the pre-money valuation, has to include the option pool. That 10% doesn't include those SAFEs or that convertible note. So those all have to be part of that 90%. And so if you're the founder of the company and it's just you, and you have 100% before you start this deal, and you take in some capital with those SAFEs, and you add your option pool and your new investor, now all of a sudden your 100% is no longer just 90% because of the new investment, but it's also maybe 80% because you have a 10% option pool, and now maybe it's also 70% because you have another 10% for your convertible notes. When we say it, we say frequently, oh, those will come out of the pre-money valuation, or those will all be part of the pre. And the real point to think about that is, in connection with these term sheets, is really that it's frankly coming from the founding team. One other quick thought on this, and folks will disagree with this, but when we think about what's important relative to term sheets, I mean, in my mind, I kind of think about, like, if I go into a casino, no connection between the odds of any of these things, right? But if I had 100 chips, well, where would I place all my chips? And in connection with negotiating the term sheet, and a lot of times what we'll say is that we would put a large portion of those, maybe even 3/4 or more around this valuation issue, because at the end of the day, a lot of the other things we're going to talk about today are going to be important, but really how much of the company that the founding team continues to hold after an investment round will, well, frankly, you've started the company to go build it so it's going to be sold. That's what's going to be most important. Try to preserve as large of a percentage as possible with as high of a valuation as possible, which is why this is the first slide in what really matters.
Wait, another quick point I want to make. To say what Jonathon just said a little bit differently, where you put the stock option pool, where the convertible notes convert, is really another way of a valuation conversation. Depending on the leverage between the investor and the company, which is something that sort of swings back and forth with market conditions, help guide that conversation as part of the term sheet. I agree with Jonathon. It is probably the most important part of a conversation, a term sheet conversation, because it governs a lot of things. But part of our job as lawyers, part of JumpStart's job, is to also lay the foundation, a proper foundation for future capital raising. So one thing I always think, and sometimes say out loud, is you want to be careful with the valuation negotiation, because for example, from the company's perspective, you don't want to be too successful. If you get too high of a valuation, if you negotiate too well, so to speak, you could have trouble when it's time to raise that next round of capital, and that can lead to some difficult conversations with existing investors and conversations about dilution and anti-dilution, which we'll talk about a little bit later.
So the key takeaway, most investors are going to think about the same example, going back to the same example, most investors who know what they're doing are going to think about valuation through the lens of what percentage equity is that investment group buying, and everything else generally happens in the pre-money, which goes to maybe we need a different valuation. Maybe there's an increase in valuation, but the post-money is what the investor looks at most of the times. So next topic, liquidation preference. Howard, what is liquidation preference?
So liquidation preference is something that the definition is a sort of a broad category, and it changes from time to time. A liquidation preference means the investors who invest in equity, if they own preferred stock, which is generally what makes it preferred stock, is the fact that it has a liquidation preference as a general rule. They get paid first in an exit scenario or any type of liquidation scenario. As an investor, you would take the position, I'm going to put money into the company, I'm going to invest in the company, but I don't want I should get something better than the common stockholders and the founders have. And in the downside scenario, I should be entitled to some priority, some preference ahead of the founders because I'm the one who's taking the capital risk. So therefore, I would invest as an investor in preferred stock that has a liquidation preference and allows me to theoretically get out first in the equity capital stack on an exit transaction. Often, it can be viewed solely as a downside protection. I'll revisit that in a second, but I want to make sure Jonathon has an opportunity to talk about ownership percentage versus waterfall percentage, and then we can revisit the downside protection nature of liquidation preference.
And before I talk about that, I just want to reiterate how incredibly bright those lights are. And so if you do have questions, we can't see anything. Which is not to say they should turn down. I don't mean to suggest that. We can't see you. So wave to someone with a microphone. The ownership percentage versus waterfall percentage. So waterfall, quickly, is kind of this this nickname we give a spreadsheet, frankly, that describes exactly how the money gets distributed when the company is sold. And back to our 90-10 example, that feels easy because if the company sells for $100 million, I think usually 10% of that would go to the investors, 90% goes back to the common stockholders. We had those option holders. It's a little bit of complexity there, but that's the waterfall. So how it would flow, how the funds would flow, to keep up the water metaphor, is what that means. Now, there are definitely instances, though, where that waterfall is not the same. So that split of 90-10 doesn't exactly follow. So one of the things that could affect that, frankly, are those options. They will change slightly some of the percentages. Another thing that can affect it, depending on how the documents are written in the negotiation, are dividends, for example. And this is a really easy way, a really easy example, and it's not as applicable, I think, as folks think it is, or not as frequently applicable as folks think it will be, but it's an easy way to think about it, that if there's a 6% dividend over some period of time, 10 years on $1 million that's been invested, I can't even do that math in my head, but I know that what it means is that now the combination of 6% annually plus the $1 million that was invested, if the preferred investors will be paid that amount, it's going to be more than 10% when they get their proceeds from the sale transaction. There are other pieces of some of those puzzles, but maybe that downside protection is another good example. Howard?
Well, so liquidation preferences are a term of preferred stock that often vacillate with the market. When credit is tight, when fundings are tight, when the leverage pendulum swings toward investors, you often start to see different forms of liquidation preferences. The most company-friendly liquidation preference is really a one-time, non-participating preferred stock, and that's what I mean by downside protection. And what that means is, if an investor invests in preferred stock and it only has a one-time liquidation preference, not participating preferred, so it's just a true convertible preferred, the investor will have a decision to make. Do they take their preference, or do they convert it and take what they would otherwise get if they were common stock? It's a choice. 1x what they invested, or theoretically the upside if they were to convert. And that's why sometimes a true convertible preferred stock is referred to as downside protection. In the bad scenario, preferred stock has protection. It gets its 1x original investment value back. But in the upside, preferred stock converts all the time, and it doesn't really function as preferred stock economically. It functions as common stock economically, because the investor who owns preferred stock would convert every single time to get more money in the exit transaction. When the pendulum swings to investor-friendly terms, sometimes you will see 1.5x, 2x, or a participating preferred, and that participation means not only does an investor get the investor's original investment amount back, in addition to that, it will then participate on a pro rata basis as if it were common stock. To Jonathan's point, that all changes ownership percentage versus waterfall percentage. Waterfall percentage can be substantially higher with a lot of those different permutations of preferred stock.
And sorry, Hardik.
Go ahead.
Thank you. So just one other quick thought on that. Howard mentioned earlier that the differential that might be achieved with respect to the option pool or convertible notes are a function of valuation. Likewise, this would be the case too. So you can see a situation where an investor might say, hey, well, we want more of that downside protection, so we'll take a 2x liquidation preference. As on the company side, the founding team might say, okay, well, that's fine, but that means you'll have more downside protection. Great, but we'd like a higher valuation, so that then that way, if that preferred stock converts to common, then in an upside scenario, right, sale that's wildly successful, well, in those instances, then obviously the founding team ends up with a larger percentage. So greater downside protection, you get more out first if it's a modest outcome, but greater kind of portion of the upside for the actual founding team.
So one more quick comment.
Go ahead.
Is just tying it back to the theme here. I would argue, and using Jonathon's system, I would allocate real chips, real points to this one. I do think this is an important component of a term sheet conversation. And it really is part of the first topic. It's part of the pre-money, post-money conversation because it really does affect directly the economics that everybody is trying to achieve.
You can talk now.
Okay, thank you. I was going to make a comment, but in the interest of time, let's move on to the next slide. So, what does a board for a startup look like? There are different opinions on should you have a board? Should you have just an advisory board? Can you have observers? Why not to have observers? So Howard, let's just begin with the basics. What do you typically see for tech startup boards?
So certainly some general rules. Every situation is different. Every fact and circumstance is different. But as a general rule, the earlier the company, the smaller the board should be. I think it's always a little bit of a minefield when you have a seed stage or even pre-seed stage company that has a board of 5 or 7 people. It makes me kind of I have to sort through that. We have to wonder what's really going on here. Sometimes you'll see a pre-seed stage company with really one board member. I guess it's intuitive, but you generally want to see an odd number. Believe it or not, not everybody does that, and sometimes it's something that's out of everybody's control. Sometimes you have an independent seat that maybe hasn't been filled yet because you haven't found the right industry expert to fill that one or more than one independent seat. So ideally, a board would be smaller earlier and an odd number of directors. Often at the beginning, when you have a seed stage term seed, maybe a seed investment stage company, you'll see a board of 3, and often it's one seat for an investor, maybe the lead investor, one seat for the founder, and maybe 2 seats for the founder. Sometimes it's a little too early to get that industry expert / independent director on board. Sometimes it isn't too early, so there can be some discussion around that, but that's most often what I would see at seed stage. Series A, or as the company progresses, obviously the board will get bigger, that its composition will change. Everybody should always keep the company's best interest in mind when deciding on board composition and who sits on the board and why are they on the board. I'll stop there for a second.
Actually, that's a great transition point. I mean, it's frequently confused, and we do it too. We make the mistake of not distinguishing between the different hats that folks are wearing when they get together. And so while a board, especially let's say post-Series A, there are 5 or maybe more individuals on the actual board of directors, some of them are representatives of the company's investors. Some of them are founders or representatives of the management team. And when you're sitting in a board meeting, that should be about the company's operational situation and strategy going forward. Lots of times, though, when we're talking about maybe a follow-on investment round that's going to be funded by the current investors, we talk about that in terms of, my board thinks that the terms of the next round should look like A, B, and C. Well, they're not acting as board members in that instance. They should be acting with their investor hats on. And that distinction is important from a legal perspective. We care a lot about it, and it's not usually made otherwise, but but the importance there is that as you're having, if you are founders of companies, as you're having these conversations with the people on your board, thinking about them in those different perspectives will be important as you're considering how you're actually negotiating some of these term sheets. So that's sort of the first part. The second part is that during those board meetings, and one of the things that we like to harp on is that it really should be this process where you've sold your investors on an operating plan. So now let's compare that operating plan to your actual performance. So at each of these board meetings, let's look at that budget versus your actual performance, and let's talk about that and the differences. And if your board meetings are a combination of that and strategically where the company is going to be headed, that's where you're going to get a lot of contribution from your actual board members. And like Howard said, a lot of times we refer to this independent. It's less an independent than an industry expert, someone who will tell you, hey, this is what your space is looking for, what's coming around the corner, where you should be focusing your efforts. Is that something that they're going to want to buy? One other quick point that comes up in term sheets that is usually left toward the end, but is sometimes a lead time item, is that a lot of term sheets will have a requirement that the company obtain directors and officers insurance. I don't mean to suggest that this is highly negotiated, but it takes time. And so if that's going to be a requirement of your investors, you can't expect that that you can necessarily close on that transaction without all of that teed up. And so it's important to have in your mind as you're going through the term sheet the things that could sort of slow things down. And so that's definitely one of them, and something to make sure that is on your radar. It's not something that the lawyers can help smooth over or make happen faster. Obviously, you have to go out and obtain that policy from the outside.
Yeah, I guess from my observation, just going back to what the size of the board looks like, a lot of it also largely boils down to who the check writers are. If you're raising $2 million and if you have two investors who are each putting in $500,000, then they both want the board seat in many cases. So then you end up creating a 5-person board instead of a 3-person board because the investors can't agree among themselves on who is best representing all of their interests, right? So if you do find someone in that same example, one investor is writing $1.5 million check on a $2 million raise, it's very, very likely that if you prefer as a founder a 3-person board, that's where you will end. But generally, at least in our ecosystem, that's not what we see a lot of.
So another quick point, Jonathon mentioned D&O insurance. The reason why it's important to have D&O insurance particularly when you have outside investors, is because there is real risk and real potential liability for sitting on a board of directors. The insurance is supposed to help protect that. A quick point for you founders out there, make sure that the cost of a D&O insurance policy is built into your budget.
Anything to add?
Actually, one other quick point, sorry. As a lawyer, Jonathon, I'm sure you've had this conversation, I've had this conversation a million times with a potential board member who says, I want to sit on the board. And I'll often say, well, why? Why do you want to sit on the board? Is it just a position, a status? Does it give you credibility? Do you need to be on the board to go make, what is the role? Jonathon talked about the role, the oversight role, the budgetary role. But if the idea behind sitting on a board is really just to keep tabs on what's going on, have a voice, be in the room, offer your opinion, be collaborative, then an actual board seat might not be the right fit. Being a board observer might be the right fit. And that's a conversation I have, probably more than once a week. Then there's the issue, I know you wanted, I might be speaking for Hardik, but there is often a conversation, maybe even an argument about board observers. And often companies don't want one board observer or two board observers. Sometimes an investor will say, well, I would like a board seat and 3 board observers. And there's often a conversation or argument about how many board observers are going to be permitted in the term sheet.
Yeah, I can speak from experience. We have been told various things on board observers, like there isn't enough room in the conference room to have one more person and we would say, hey, how about we join virtually? Because now we live in a post-COVID world, right? So, but I highlight that because these are like real things that happen when term sheets are getting negotiated. What feels like fairly simple thing doesn't end up being simple for various reasons.
And just one last point on the board front, and this is probably not what I'm supposed to say, but I mean, I've sat in hundreds of board meetings at this point, and Howard's spot on. We strive for odd numbers. The assumption there is that there's a vote, right? And everybody in favor say aye. And literally out of those hundreds, maybe more board meetings at this point, I could tell you the stories of the 3 times where there's been a vote, and they're all really bad stories. Like it's a really bad outcome for those companies. So look, it's important who's on the board. It's important to have their input, especially if this is your first rodeo or even your 6th. But at the end of the day, it should all be a contributory process. It's far less about sort of the adversarial nature of, hey, I have to make sure I preserve my position relative to the investors. We're going to talk about it in a slide or two, but I mean, those investors are going to have some controls over where the company's headed anyway. This is not probably not the hill to die on.
So you're not placing a lot of points on this one?
No, unless it's an issue between our clients later.
So let's move on to the next one. Protective provisions. So this is another topic that frequently we spend a lot of time debating and discussing and negotiating. There are board level protective provisions. Occasionally you will see board plus preferred investor protective provisions. And then there are just preferred stockholder protective provisions. Finally, there are just all stockholder protective provisions. So, Howard?
So yeah, just sort of setting the foundation for protective provisions. What are they? They are a list of things and often will be in the term sheet that the company can't do without getting somebody's consent. So then the discussion usually revolves around what is that list? What are the list of things we can't do without getting consent as the company? And then the second part of that conversation revolves around who has the ability to give that consent. But this is something that does tend to get maybe a disproportionate amount of attention in term sheets.
So a few examples of those types of things, right? I mean, you frequently will see the company can't go raise additional capital without the approval of the investors. The company can't sell without the approval of the investors. The company can't change its line of business without the approval of the investors. I'm sure if I were a founder of a startup, I would be offended by the notion that these folks who aren't in it day to day, nights, weekends, et cetera, could tell me, whether or not I can take that next step. I think the other side of that coin, though, is that they're putting the money in that's allowing you to continue down that path, and so they're going to want some controls around it. B, they could have some good insight into what those outcomes should be. If, for example, it's a sale transaction, they want to make sure from their investor perspective that, they have a good outcome. They have certain requirements back to their own investors. But they might also better understand what the market opportunity is, and so they can give you that input. I think the last part of it, though, is that even though there might be some friction in negotiating an investment transaction, once that money's in, really the company or the management team, the founders on the one hand and the investors on the other hand should really be driving in the same direction. And so the one that seems to get the most concern when we talk about it is preventing a company from taking on another round of investment. Your investors will want that. Now, there are certain investors who might not, and sometimes a strategic investor might want to keep you all for himself. But broadly, a traditional venture capital investor is going to want you to grow such that you've achieved some valuation inflection point, and then and need to take on capital for the next round. And so they're going to be in favor of raising that next round. They don't want you to take the dollars at some, crazy terms, et cetera, but that's the point of these protective provisions.
This is also something that changes as a company matures. For example, there's a sort of a standard list. If you look in the NBCA template term sheet, you'll see a pretty fulsome list of potential protective provisions. But in a small early seed round, particularly if that seed round is funded by maybe some friends and family and high net worth individuals, but not necessarily institutional investors or venture funds, is it appropriate to have the big list? Is it appropriate to have that type of investor have veto rights over future priced equity rounds or future operating decisions? I'm not sure. It's appropriate in those circumstances. I like to see less protective provisions early, and they can develop over time as different types of investors tend to invest in the company as it gains traction.
Can I say one thing? So I think, like all of the topics here, this is all a question of supply and demand. What the market conditions are at a macro level dictate a lot of those terms. But one advice to founders would be to think about, Howard just mentioned veto or blocking rights, right? So we have grown, we have matured. JumpStart, I'm speaking for as an investor, where we don't like those rights. We don't like anything that's very specific or exclusive to JumpStart or to any one particular group of investors. So to the extent that you have terms which say the majority of a certain class, that's kind of more in line with what we should be seeing versus saying that without JumpStart's approval or without ABC Fund's approval, the company cannot take any of those major actions. The only other thing I would say is it also, at least from our perspective, goes back to the whole notion of the preferred investor director approval on why do we even need that. I know, Jonathon, you and I have had multiple conversations on this topic on why do we even need that.
So the argument, and just maybe to restate it quickly, we have this list of things that the company can't do without somebody's approval, and the different buckets are, stockholder approval, which actually is a legal thing anyway, preferred stockholder approval, which could be a legal thing or could be in your investment documents. The next threshold could be, without the approval of those directors we just talked about, but the directors who are the designees of the investors. And so the company can't, for example, borrow more than $50,000 without investor director approval. Hardik raised this with respect to me because I personally think that this is not a great protection for anybody involved. I don't like giving an individual veto rights because who knows if that person's having a good day or a bad day, who knows what that person's motivations are. I also think, going back to the prior slide, that directors have fiduciary duties. We mentioned the D&O insurance and Howard's point about the actual responsibilities, and especially during times where maybe the economy is not spectacular and a company in a boardroom is talking about how it's going to next be funded, and while the investor with its investor hat on doesn't want the company to take a certain term sheet, that could be true, but if that's the only term sheet and that's the only way to make payroll, well then the investor director sitting in that boardroom really doesn't have a ton of choice to vote in favor of it, or really can't vote against it because of that investor director's fiduciary duties. It creates this weird dynamic that's also very hard to explain as lawyers when we're sitting in those boardrooms, why they can vote against the term sheet as an investor, but they have to vote in favor of it essentially to keep the lights on as the director. It's super confusing, and I think that it just is bad all around. But obviously not everybody agrees.
Well, I agree. The next few topics we are going to do a rapid fire, so we'll leave a few questions for the audience towards the end. This is my favorite topic, as both of you know. Founder vesting. So why can't we just agree? Literally, why can't we just agree?
Well, I think we can agree.
Okay.
But let's pretend we don't agree for a second. If I were a founder, the reason why this is a sensitive issue is a founder, from a founder's perspective, works for years, maybe, for no or little or below market actual compensation, for really what we call the proverbial sweat equity, and for some amount of time that is not insignificant, this is all the founder's been doing. And then an investor comes along and says, hey, we're going to invest in your company, but here's the term sheet, and in the term sheet there's founder vesting. And what that means is the founder's stock, the founder's common stock that the founder owns, that the founder thought they owned, now they don't really own it anymore. It's now subject to vesting, because if the founder leaves after the vesting schedule is attached to it, the founder can lose some amount of equity. There can be discussions around how much is subject to founder vesting, and there can be maybe some portion of it is fully vested and some portion of the founder's equity is then subject to vesting. But if I'm a founder, it is easy to see the perspective that why is this happening to me? I've been working nonstop for years, and this is all I have. You can't take it away.
What's the investor argument, Jonathon?
What's the investor argument?
On founder vesting or the investor position.
Yeah, sorry. I mean, look, the flip side is, as an investor, if I'm putting in 2 years worth of runway, I want to make sure that the founding team that I'm investing in is going to be there for 2 years. And to be perfectly honest, if I'm a founder and someone's putting 2 years worth of capital into my business, I think it's very hard, and I think this is why we can agree. I think it's very hard to turn around and say to your investors, hey, I don't want to have to vest into my shares over that 2-year period, because it sort of seems like maybe you won't be around for that period of time. Now, to Howard's point, it's why we frequently will find some compromise, though, because another point from a founder might be, well, wait a second, what if on my way out of the bank after depositing all of my investment capital, I get hit by a bus and I die? And you're telling me that my family is not going to benefit from any of the last however many years that I poured all of this effort into this business? And, that's a legitimate concern. And so instead we might say, okay, fine, we're going to take half of your shares and they'll be fully vested, and the other half of your shares are going to vest over that 2-year period. It's really, from an investor's perspective, the way to make sure that you continue to have skin in the game and are doing, all the crazy nights and weekends that you've been doing up to that point that led to their investment.
Yeah, the only other thing I would add is there's this concept of dead equity, right? If you have a founder who is no longer working with the business, let's say there are 3 founders and 2 of them are still working, but the third person has left the business, that's where vesting and other topics become really important, because now future investors see that in a negative way, because now you're creating value for someone who is no longer involved day to day. But I like the concept that I've learned from people here on this panel on vest to the next round. Agree to something that allows you to vest to the next round, and the founder side of it is it will get renegotiated again at the next round. So this will keep on happening. So now let's talk about the easy stuff. What about information rights, preemptive rights? So information rights is just access to business performance metrics and financials. Preemptive rights is the ability to participate in a future funding round. Do we generally agree on that?
Yeah, I think so. I mean, look, there's always stuff to negotiate on, and we can. It's how, as lawyers, we look really smart by heavily negotiating things. But the truth of it is that at the end of the day, if the investors want to see monthly and quarterly and annual financials, or the investors want the chance to invest in your company in the next round, giving them those opportunities are kind of table stakes at this point. And so Look, if you're a very early stage company and you just flat out don't have the ability to prepare monthly financial statements, there are some good service providers who can help you, likely in the audience. But maybe that's a reason why you ask your investors if they can be quarterly. Sometimes those information rights ask that your financial statements be audited. Well, that might not be practical. And so again, you can tweak some of those things, but in reality, I think it makes a lot of sense to give folks these opportunities. I don't know, you want to talk about major investor stuff?
So investors generally want the management team focused on the prize, which is building value. But many of these things, like information rights, are a discussion because if I was an investor, I wouldn't want to create cumbersome, busy work for the management team. I want them focused on growing the company. So if they're not doing monthlies, if there's some reason we need monthlies, then maybe we can have that conversation. But if they're not doing monthlies, as an investor, maybe I don't need to. I don't need monthlies. We can do quarterlies. We can do annual budgets and annual statements. I do think there should be a conversation around what's administratively easy so that the management team is properly focused. Also, in terms of administrative ease, there is often a discussion in a term sheet around, well, who gets information rights? Who gets preemptive rights? Not so much an issue if there's an institutional investor-led round or if it's a big round where you have big investors, but in seed stage or pre-seed stage financings, often you have many small investors. And just for administrative ease and to have the company, again, focused on what's important, you create this definition of major investor, and that's who gets the right to this information. That's who has preemptive rights. So investors who invest under a certain threshold would not be considered major investors and therefore would not get information rights and not have preemptive rights. Doesn't mean the company won't give that investor information, and doesn't mean the company won't permit that investor to invest in a future round. They just don't have the contractual right to do so. And again, often where that threshold lands for the definition of major investor is a function of really making it administratively relatively easy for the company.
Sorry, Hardik. One other quick point on this, because I think it's important, especially for this audience, is that a lot of times investors will ask for things beyond their financial statements, certain amounts of reporting, and I think it's just important to know that frequently that's not for their own purposes. They're not asking for it just kind of for fun, and in particular, the state of Ohio supports a lot of the investment funds that are circulated throughout the state, and they have certain reporting information requirements, and so obviously the investors who have those state dollars are going to ask for that information as well. So, it might seem a bit of a pain, but sometimes those investors have a need for it otherwise.
Yeah, a lot of this will boil down to what your cap table looks like. Do you have 5 investors on your cap table, or do you have 50? But the most important thing from a founder perspective is you don't want to surprise your investors. You don't want to surprise your boards. So the more you communicate in whatever format that works for you, that is not a significant burden, the better you all will be. I know we have maybe just very quickly, because we do want to leave some time for questions, but just very briefly explain redemption rights and registration rights, and then we'll open it up for questions.
So just quickly, redemption rights are basically an investor's right to sell its shares back to the company after a certain period of time, usually like 5 years. And again, investors have their own investors most times, and so they need the ability to achieve some liquidity, and so they have this right to sell them back. Similarly, registration rights are an investor's rights to prompt or cause the company to go and sell shares to the public, right? Go list them, have an IPO. I think when Howard and I were talking about this before, and I'll let you speak for yourself, but I've literally never had a company have the registration rights triggered, and likewise with redemption. I mean, we've used them to threaten, from an investor side, but otherwise, these things are virtually, they never come into play, and really, we most frequently see them back to that pendulum swing as things come back to the pro investor side of things, but not terribly applicable.
Yeah, I feel like I've seen redemption rights maybe exercised once or twice in my entire career so far. It's a leverage thing. It allows a conversation to happen at some point in the future, but if an investor is trying to exercise redemption rights, it usually means that something's not going well and the company probably does not have the funds available to repurchase the investor's stock anyway, which is what triggers the conversation that's going to be had. Many term sheets for many years did not even have this provision. It's something that sort of swings back and forth with market conditions. Registration rights are an interesting term sheet item. Often in a term sheet, it takes up, would you say the registration rights provision might take up 40% of a term sheet? And it's something that probably you will never, ever look at and never, ever need. So often you'll see a term sheet that just says, hey, the investor will get registration rights if anybody else ever gets registration rights, and we just leave it at that. This is one of those things that I often say to a company, I hope one day we argue about what we had in this term sheet about registration rights, because it means you are having an initial public offering. The chances of a company having an initial public offering are so remote because not only does your company need to be wildly successful, the exit mechanism needs to be an initial public offering as opposed to just an exit or some other strategic transaction, and it is just so unlikely that to spend a lot of time negotiating demand versus voluntary registration rights is time not well spent.
Okay, we have time for some questions. Any questions?
We know what the registration rates say. We could talk about
Neil?
So could you talk about the changing terms as the market dynamics have changed and what you anticipate over the next period of time as you look into your crystal ball?
So I think the easiest thing, and frankly it's the most important thing, right, is valuation. And for the longest time, we really saw valuations at very high levels, which meant that founders were selling smaller parts of the company. It did become hard to keep up with that as the companies grew, and Howard alluded a little bit to that. That can be difficult. And so I really think that going forward we'll continue to see, because we've seen it in the last 18 to 24 months, valuations return maybe to a more modest level. The other thing I'll mention is that list of protective provisions we mentioned, all the things that the company can't do. It got very bright in here just now. It got very, that list got very short for a long time, and now we're starting to see the list creep up, back up. I don't know, Howard, other things you've seen or expect to see?
I haven't seen anything different. I heard the question differently, and you may have meant it the way Jonathon answered it, but I'm going to answer it the way I heard it anyway, which is, I think there have been some changes in the market involving process and the standardization of terms and the standardization of documents. When Jonathon and I started, there wasn't an NBCA form document. There wasn't a Y Combinator form safe. So it was a little bit of the Wild West. There were market terms, but in any given pocket or in any given transaction, you really had no idea what you would expect to see. It has evolved to a point now where when you see documents in an investment transaction, the first thing you really want to do is say, can you redline these to the standard NBCA documents? Let me see what you changed. I think that has made the process more efficient and less expensive for everybody involved.
Yeah, from our perspective, going back to how Jonathon answered the question, at a macro level, if you are a high-performing business that's executing on your milestones, you will raise money. We have plenty of examples of that in our portfolio, up and down markets, boom times, bust times. As long as, the valuation may not be what you expected maybe in early 2021, But the key here is focus on execution against your milestones. As long as you do that, you will have opportunities to find the right investor.
If anybody's heard me tell this story before, I apologize in advance. But I had a venture fund client who was asked that same question when he was on a panel, and I've always loved his answer, so I'm going to try to reproduce it here, which is, he's a venture guy, and he was asked how he values, I think it was a pre-revenue software company. He said, well, first, we take the 5-year discounted cash flow analysis, we analyze that, we analyze the 3-year discounted cash flow analysis, we look at comps, we look at projections, we come up with our analysis, we then determine that the valuation is whatever it is based on that analysis, and then we multiply it by 0 and add $1 million. Which is another way of saying, good question.
Yeah, I would actually, I try to flip it around. I think in those situations, it's a lot about ownership percentage, and,
right.
and then let's apply dollars to it. So if you need to raise $2 million, and as a founding team, you refuse for your portion to go below 80%, well then it needs to be an $8 million pre-money valuation. If you came to me and said you're pre-revenue and you're working on a software product and you refuse to go below the 80% threshold and you need $2 million, I would tell you that there aren't going to be very many investors who are going to use an $8 million pre-money valuation for your pre-revenue software company. But I would relate it all back to your ownership percentage, and then let's figure out the dollars from there.
Yeah, you also want to think about it, like if you think about it from investors' perspective, they are investing money to generate a return, right? That's their fiduciary role that they have taken money from their LPs for. So the simple math that most investors are going to do at a super early stage is, at a minimum, if things go to plan, can this investment get us a 10x return on our investment or more? So if you do the math, and if you say that the only way this pre-seed investor is going to get a 10x return is if we sell for $1 billion, well, something is wrong in that equation, right? Because not many companies sell for $1 billion. So yes, it's a question of how much dilution you are willing to take. It's also a question of how big the market opportunity is. And so maybe the question from the founder's side is tying dilution to what can you do with as little capital as you can at a super early stage so that you can demonstrate product market fit and you can demonstrate some traction, which will then allow some more multiples and other means for your business to be valued at.
What's the number one term you would recommend to a first-time founder getting their first term sheet to either ensure that that's in there, or what's the wisest founder-sided terms you've seen?
So founder side terms, founder perspective, obviously valuation is going to be really important. You want to get that right because it will govern relationships and expectations for it well into the future. Multiple rounds of capital will kind of depend on how that initial valuation conversation happened. If I had to pick something sort of secondary in importance, it's probably board composition at that early stage.
I agree on valuation. I guess I might add a different secondary, which would be the speed with which you take on the initial investor. Because as lots of folks could attest to, the hardest is that first round. And if you need to raise $1 million and you can get the first 750 from an investor for 20%, you really wanted it to only be 10%, I think that compromising or giving that to get that first investor in the door it's almost irrelevant as to what the other terms might be, because it's unlikely you have others that'll follow on. So whatever you can do to get that first investor of substance in, I would also warn you against having the first investor be $25,000 on $1 million round, because that's not going to be terribly helpful. But if it's of substance, I would say whatever you can do to do that, it's going to be your most important term.
You didn't ask me, but I'll still opine. I think it's actually, from my perspective, it's a term that doesn't exist in the term sheet. It's about alignment, making sure that whoever you are taking money from sees the business the same way you see the business. Because all the factors that we spoke about here, and there are a dozen others that we did not discuss, can all be managed if you are aligned. But if for some reason you are selling something that they don't want, or if they are trying to convince you to do things that you don't want, then this is a long-term relationship that's very difficult to get out of. And it's always, always complicated and never works out. So spend more time doing your diligence on the investor to make sure you are aligned with their philosophy. With that wraps up our panel. Thank you, Jonathon. Thank you, Howard.
Thanks.
Next session is going to be here at 11:45 on the intersection of fintech and wellness. Both Jonathon and Howard, you might stay around for a little bit here if people have questions and want to hang out with you.